After a surging market in 2023 and 2024, can the bull market rally be sustained in 2025? I got a few reasons that give me pause. I'll share those and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. There's lots of data points that are still very bullish or very optimistic about the market, despite the big rallies in 23 and 24. You could say the 23 rally was really a rebound after the awful, 2022, and we've seen earnings growth just, really accelerate. And so 2024 was in response to that, but also some optimism about what's ahead in the future. And if you just look at bull markets, they tend to last a while. They tend to run, okay? And we did see a bear market in 2022. There wasn't a confirmed recession, but we saw a bear market, a decline of 20%. And we've been in this then bull market in response following that bear when it bottomed out in October of 22. And so therefore it's just over 2 years old. And they tend to last around 5 or 6. After 2 years, they tend to lose a little bit of steam and they're a little bit slower. And that's all history. And so we can't see the future. You can't see the future. You can't see around the corner. And so you rely on history, and therefore history and a lot of other data points suggest this bull market will continue to run. And when you add on top of that all the forecasts from Wall Street saying stock market's going to do great next year, and even some really optimistic expectations of the stock market could do another close to 20% return next year. The average estimate is around 10%. But at the same time, so despite even Wall Street's optimism, we proved a few weeks ago in a video that, those are just guesses. No one, even with more data or maybe a little bit more awareness of the markets, they can't predict the future, just like the rest of us can't. So we're optimistic about what lies ahead, again, based on history. However, there are a few things that just give me pause, and I want to share those with you and then tell you a few things that you should be doing about it. First is the valuations in the market are stretched, okay? They are stretched, and that's not to mean, the stock market's near all-time highs and therefore the value must be high. No. Stocks or businesses are valued based on profits, based on the actual profits of those businesses. And as profits have continued to rise to record levels, that's going to push prices higher. The question then is, has the price increase outpaced the profit increase? Okay, has the price increase outpaced the profit increase? And one of the measures of that is the PE ratio, the price to earnings or price to profit ratio. And what's important about this one, a lot of them that you can look at, Schiller PE and some of those, they look at past earnings, so the price today to the most recently reported earnings. That's helpful. To me, I think it's more helpful to look at projected earnings. These companies are forecasting what their earnings are going to be. So what's the price compared to those projected earnings? And you can see, based on where they stand today compared to history, at least in the U.S. markets, the price to earnings ratio is way above average. And I mean way above. And you could argue, and I've heard it before, that with tech companies and all the growth and so on, the multiples are going to get a little stretched, and so they might not compare well to history. I get that. And yet at the same time, I'm also careful to say, I wouldn't say this time is different. So valuations seem stretched, and therefore if profits continue to go to rise, that's fantastic. However, at the same time, it's already priced in. A lot of it's already priced in. In addition to that kind of measure of valuation, take a look here just recently from Apple. I told you that businesses are valued, so the stock price is really based on the earnings and the earnings projections in the future. No. This is price to sales, price to revenue, okay? Before all the expenses. Never been higher. And you're going to see some outlandish prices of the stock compared to sales when you're looking at up-and-coming tech companies. Tesla is one, Nvidia another. A lot of these where they just haven't been around that long and the expectations in the future are just really unbelievable, incredible, because they're on the cutting edge of some really exciting things. You're going to see price to sales at a really high level. Apple, for as dominant as they are, they're not that exciting. They're not on the cutting edge of a lot of things. In fact, they were on the cutting edge once or twice, and then they've sort of remained a little bit behind the others and not wanting to have the first mover advantage or disadvantage. And so for Apple to be priced at this high a level compared to their sales is alarming from an evaluation standpoint. So that's the first thing that gives me a little bit of pause about all the optimism. And the second sort of flows right out of that. And the greatest investor of our generation, and maybe ever, okay, Warren Buffett, is sitting on a record level of cash. Never had this much cash in his portfolio. And he is someone that believes in the market. And if you cornered him and said, wait a second, Warren, you got a lot of cash. Is that because you're scared? No way. He's not going to say he is. He's a believer in the markets, and he's very, very clear of his stewardship responsibility with resources, that he's got to or needs to position those resources to earn a real return, a return above and beyond inflation, and one that is handedly above and beyond inflation. So he's okay being subject to the ups and downs of the markets, the volatility of the markets, when he believes, no, there's value here. We're going to be able to outpace inflation. Sitting on a record level of cash, an astonishing level of dollars sitting there idle. And when the greatest investor of our generation, it has a defensive posture, just makes me pause, just a little bit. And even when you look at the Buffett indicator, and you could say, hey, he made that quote 25 years ago, and maybe doesn't apply as much anymore based on global GDPs and what's happening with money supply. The Buffett indicator, well, has been dangerously overvalued for a long time, and certainly still is. But it's more Warren Buffett's behavior within Berkshire Hathaway that is catching my attention. I'm optimistic, but cautiously, because of what Warren's doing. And then lastly, and I'm sure you can relate to this, but it's last on my list, but another thing that just gives me pause is there is so much economic and geopolitical and global uncertainty out there that anyone that can stand at the beginning of a year and say, this is what I think is going to happen, when you have no idea the sort of conflicts or sort of issues that we're going to face, you can't believe that forecast. And obviously things have gotten a little bit more interesting and frightening with conflicts throughout the world and our involvement and all of that. And so that also gives me pause. Typically, when there are conflicts like that, the stock market tends to do fine because there's a lot of government spending and there's a lot of profits being made there. But at the same time, the government has been spending a lot. And so if we get into that time frame, will they continue to be able to spend? That also gives me pause. So guys, I'm optimistic for the future. I'm optimistic based on history. However, I would say cautiously so. So what do you do about it? And I would remind you of two things. This is exactly what I'm preaching to myself. Stay the course. Stay the course. And that applies to good times. Don't get out too much weight in front of your skis here, but also in sort of scary times. Stay the course. Stick to your strategies, your long-term strategies, ride through the ups and downs, and refer back to your financial plan. Ensure that your investment strategies are connected and appropriate to your risk level and the goals that you're pursuing, connected to your financial plan, and stay the course. That is number one. No matter what's ahead, no matter if it's wild optimism or some concern, stay the course. And second, I would tell you to expect volatility, because when we brace ourselves for that, then we are less driven by our emotions when it actually does show up. Did it show up in 2024? Not really. Not really. There wasn't a lot of volatility, and you could pick a certain day or a certain week and say, see, it was right there. I know, guys, but that wasn't really it. There tends to be periods where the market's going to drop about 15% from a high point to a low point any given year. We didn't see that. And so there wasn't a lot of extreme selling. There wasn't a lot of extreme volatility. That's a normal feature of the market that we just didn't see last year. And that's not a bug in the market, that's just a normal feature. We didn't see it last year. We've got some of these headwinds. I would expect it again this upcoming year. And with that expectation, know that you don't need to panic and freak out when that does occur. Do you have the right investment strategy connected to your financial plans that can weather the storm? Either appreciate when times are good and play defense when times are bad. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.